Hey guys, how's it going? It's Andy from Magoo Investing. Happy Saturday. We are now in the beginning of April, and for pretty much every year except for the past 2 years, that means that tax day is pretty close, about 2 weeks away, April 15th if you didn't know. But this year the tax day has been moved back, I believe, to May 17th. So for people like myself that owes the IRS money, that was kind of a welcome delaying of me having to pay the government my money. And with taxes coming up, a lot of people are getting ready to file because obviously the IRS is a very scary thing, and you don't want to be on the bad side of the IRS. And I saw this it's interesting, but it's really sad article from Forbes talking about an investor that has a very unfortunate situation when it comes to the tax bill for this year. And it's one of the types of rules for taxes that I feel like not a lot of people know. The kind of general understanding for most people is that if you buy and sell for less than a year, it just gets taxed as your normal income bracket. But if you hold for longer than a year, you get tax benefits because the IRS wants to incentivize people to hold on to investments for longer, and you get taxed at a lower tax bracket. And for people making under like $41,000, I think, as a single filer, you pay $0 on that type of income. So there's benefits for holding for longer than a year. But there's a kind of sneaky type of tax law that most people, myself included, didn't know about. And I think going into the Gamestop and AMC situation that we had at the beginning of this year, I'm worried that a lot of people are going to be in a really tough spot. So today we're going to be talking about the wash sale rule and what it means for investors, and kind of explain what happened to this person that made a net profit of $45,000 in 2020, but the IRS says that they owe $800,000 in taxes for those trades, because that is a life-ruining amount of money. I mean, I don't know how you recover from that. It's not the idea that, you know, you're in debt and you can pay it off slowly. The IRS is going to want their money, and $800,000 for $45,000 in net profit, that's a horrible situation to be in. So today we're going to be talking about kind of what that means, what the wash rule means, how to avoid it, and just have a discussion about how we need to improve as a country, because we kind of grow up having this understanding that, you know, we need to invest for retirement, but we don't get taught in the public education system how to do it, how to avoid some of these pitfalls, like how to avoid this wash sale rule, because I'm sure a lot of people are going to get screwed over by this based off of what we saw with the incredible popularity of investing in companies like GameStop and AMC at the beginning of the year. So let's talk about this article that I found, because it's very interesting. So the headline is Robinhood trader may face $800,000 tax bill. Basically, the idea is that this Robinhood newbie is facing a potential tax bill of $800,000 despite only making $45,000 in net trading profit. This Robinhood trader transacted $45 million of total trades with a net profit of $45,000. He had between $200,000 and $2 million in trading volume per day, completing between 10 to 50 trades per day. So one of the ways that smaller investors are kind of limited from investing in the stock market has to do with the pattern day trade rule, which limits accounts under $25,000 to 3-day trades over a 5-day span. And so if you have more than that, you're allowed to day trade as much as you really want. And this person obviously took advantage of that, having trading volume between $200,000 and $2 million in volume per day. And so we don't exactly know how large of a portfolio this person was trading with, but if they're averaging 10 to 50 trades per day, we can speculate that's between like $50,000 and like $500,000. So definitely not a small portfolio, but when you get to the end of the year, the way that most people kind of look at how they did is they look at net profit, because, I mean, that's what your broker is going to show it as. And the thing that the brokerage is not going to show is what the wash sale rule is going to look like. And so this guy tried to fill out his taxes on TurboTax and said that he made $1.4 million in capital gains income, which results in a tax bill of just over $800,000. And so basically what happened is there's this wash sale rule. And the idea is that to try to make sure that people aren't abusing the kind of the rules that are set in place for tax losses. So I've talked about on this channel that towards the end of the year, especially if we've had a very green year, you see a lot of tax selling, and it's called tax loss harvesting. And the idea is that you can offset some of your gains during the year by selling some of your not as successful positions. So say you make $5,000 in profit, but you have a position that's at a $5,000 loss. If you sell that position, you get to keep the cash that was already invested in that, and it shows the IRS that you have a net zero gain for the year. And so for most people, that makes a lot of sense. And you can lower your tax bill, which, I mean, is the whole way that, you know, a lot of these companies and rich people make a lot of money, is you avoid paying taxes. And it makes sense. But there's this wash sale rule that was put in place to try to make sure that people don't abuse that, because one of the ways that I see talked about a lot on Wall Street Bets is that if you have a major loss, you can write off $3,000 of income a year until you run out of that loss. And so for most people, that makes a lot of sense. But one of the problems that this person got into is that if you sell for a loss and then buy back the same stock or security within 30 days, the loss gets taken away. And so this is going to be a huge problem for a lot of people that were, swing trading or day trading the crazy momentum that we saw on stuff like GameStop, because when they look at their portfolio, they can see, the net profit that they made. But if you're buying back the same stock that you sold at a loss, that loss is going to be disallowed. And so that's how this person ended up with $45,000 of net profit, even though the IRS thought that they had $1.4 million of profit, because the losses that they had in their mind were being offset, but they weren't. And so this becomes a really big problem about a year from now when people are trying to deal with their taxes, because in 2019, 10% of trading volume was for retail traders, and then in this past year it was up to 25%. And I'm assuming the data that we could see for Q1 of this year is going to be closer to like 35%. So a lot of people were definitely getting involved, and this doesn't just apply to stocks, it also applies to options. So when you go on Wall Street Bets, you can categorize some of the posts by gains, losses, and kind of just see what's happening. And you see all these losses, and in their mind, they can probably write these off as taxes for years to come. If they're losing like $40,000, they can write that off for, 13 years of the $3,000 tax benefit. But if they buy that stock back or buy another option within the next 30 days, that loss is going to be disallowed. And this leads to some very tricky situations that I think we need to change how we handle our financial education in schools. Because the whole reason for me starting this channel was because most people don't have the type of investing background that I have. I grew up in a household that talked a lot about stocks, and I was very interested on it early on, but most of my friends and people that I went to school with are just now learning. I have people that are reaching out to me based off of the GameStop craze that were trying to get involved, and you get put into the spot where you kind of have some general understanding of how the stock market works, but there's some of these sneaky little rules that are going to screw up a lot of people, especially in the next year. And it's part of the problem of the IRS kind of screws over people. It's the whole point of they want as much money as they can. So there's no rules put in place where if you sell for a profit and then buy it back within a couple of days, they don't care because that gets put as income and they're going to be making money from it. But they're trying to limit the amount of tax loss harvesting that people can have. And it's going to result in some people having, just crippling amounts of IRS debt. And from everything I've heard from all of the podcasts and books that I've read, IRS debt is probably the last place you'd want to have debt. And so it's going to be very interesting to see what comes out of this, because I'm sure this investor is not the only person that's done this. And I don't know, I'm very worried for people that just got involved with the stock market, because I'm assuming this is going to cripple a lot of people. People understand some of the basic rules of tax loss harvesting, but for someone like myself, I've been pretty involved with the stock market. Shoot, I've been making videos on this channel for like 2.5 years at this point. Even I didn't know about this rule. So let me know if you've known about this rule before and if you've ever been affected by it, because this would be a very horrible situation to be in if people are doing some high volume trades. The IRS thinks you're making millions, but in reality, you're making thousands. And then you got a massive tax bill. So very curious if you've ever had experiences with this, or if this is the first time that you've heard of the wash sale rule. So let me know what you guys thought overall. I will see you guys on the next video. Thank you all for supporting my channel.